Hi, this is Shane with the Rational Trader. It is Monday, the 17th. I was out last week traveling, so the system was trading by itself. I was just kicking off in the morning remotely. It was really a rough week last week. My result for today is 540. We'll look at that real quick, but I'd really like to talk about last week. So here's today. Markets are really volatile, very dangerous. For the small account trader. Let's see, where did we start here? We didn't start until 7:05 today, so our normal rules state that when the average daily range gets above 100 points in the NASDAQ to kick into the super cautious rules, that means we use the model that's designed for volatile markets. And really what it means is that it's stricter in terms of what the signal looks like. It has to be a much clearer signal because there's more noise in the market, basically. Range and volatility equate to randomness. So sorting out the signal from the noise gets more difficult. So the system here, hang on, it's a little loud. The system here, just one of these amazing bottoms here that it caught. This 101 is a turning behavior. And we make a little bit, and we hit our first target. We add here on the break. There's no follow through. This has been a theme recently. And then the market pulls back, and we stop out. So +5, +7.5, -1. Market's going to go sideways here for a bit. Now you'll notice here that the market spends, this line here is the value area low. So to make that bigger, let's look at it here. The value area high is way up here. It's at the high of the day at this point in time. So it's up here, okay? And so what's happening is the market is spending so much time down here, it's shifting the volume, the total volume. So between those lines means 70% of the volume of that day is traded between the high and the low. So much trading happens down here, all right, that this line comes down, and this is going to be important when we look at the next chart. Let's see what else happens here. So I saw this happen, but then I stepped away. So let's see here. These are pretty violent moves down. Okay, so we catch this pullback here and get, it looks very similar, doesn't it? You get your first target, you get, you do an add on the break there, and then you make a little bit actually on that add. So 5 and then 11 and then 2.5. And then we take a loss here on a long break. All right, so that's -2, -1.5. So we must have hit first target, or I'm sorry, we must have hit 10 ticks, and then the stop moves to -5. And then took some slippage on that stop. What else do we have? Okay, these are big moves, wow. The problem with these big moves is that you see them and you get stars in your eyes thinking that you're going to make all this money, but when it's this volatile, it's much more difficult to find a good entry and then survive. What we saw last week was just lots and lots of, okay, that's it. Lots and lots of really violent reversals. In fact, let's take a look at that real quick right now. So here's the 30-minute chart. Interesting, I drew that fib this morning. And what I want to point out here is the size of these moves is simply enormous. These are really big moves. Look at this. Look at this. And then, you know, all this is last week. Down and up and then down. That's a 94 to, it's a 60-point move top to bottom there. And then here you get it again. 60 down, 40 up, 20 down. These are big moves. So if you're on the wrong side of them, you're going to get killed. All right. This is Wednesday. This is the day actually that is kind of the most interesting because in the sim that I'm testing for the next release just killed it on this day. Made in sim over $1,000 trading 2 contracts. But when you look at the week as a whole, it was really a rough week because of all this violence. All right, all the pullbacks are really deep. So single contract traders were basically out of luck because the market would, even when you get a good entry, right, you move your stop to your entry, and then the market pulls back so deep that you get taken out for scratch. So the single contract traders in a real bind last week as a result. These moves are so violent. We were talking this morning about, being careful about this move here because that looks like a Fibonacci retracement right there. So we'll see if that's prophetic or not if this level breaks here. 7,500 was the key level right through here. You could see as soon as that broke, off it went. The problem, of course, is that if you're trying to trade this with tight stops, it's difficult to survive the gyrations. This is the refinement that I'm working on here. All right, and this is when I looked at last week. So I got back from traveling. I spent the entire weekend running different simulations on both of these charts here, and the only way to survive, or the only way that you actually made any money, was to look only at the low volume nodes. And nothing else, and only with the new sort of low volume price action behavior that I'm evaluating. So with that in mind, what I did here is I've changed this chart. I'm now added forgive me there. So what we've been doing is looking at the low volume nodes only on this chart, and doing it with two things that are new. One is that the actual price behavior that triggers a prediction is different. It's simpler than in the production charts that we're using. And the question was, well, is it too simple or not? And the answer is not clear yet, though it did extremely well last week. And then this week I've added similar simplified behaviors at the value area edges. So here and here. Actually, in this case, these bars here are close enough to that low volume node that it's basically the same in this case here, in that particular instance. Let's find the beginning of the day. All right, so, and this is a good example of the thing that we got to work through. So if 705 is here, this is when we start trading. I like what I see here. You can actually see that that's catching 198. If it starts with a 1, that's a long. You can see it's catching basically that same bottom that the production chart caught. The difference is I have an additional requirement here, and that's that if I'm below this line, I won't take any longs. And this is part of the effort to we want to focus on damping down the losses in this really volatile environment, even if it means I end up losing out on some opportunity. If the market wasn't so crazy, I wouldn't be doing that, because in sort of a normal market or a quieter market, you're not that many opportunities show up, and so you want to grab everyone you can. Here, there's so much movement. There's opportunity all over the place, and it's more a question of figuring out, okay, well, what's the highest probability in this more random environment? And so what this chart is doing, it says if I'm below the low value area, I won't take a long. And so what that means is price either has to get back up there, or, as we saw, the low value area will come down. It'll come down to price if the market keeps trading at that level. Okay. And so we started here. Let me get this back again. So we don't take that long, which hurts us in this case. Here you can see these are here it helps us. That says get long. We're at these low volume nodes here and here, and so the one there means that, okay, I'm at a point where I am making a prediction, All right, the predictions coming back do nothing, but that's what the 1 means. That's for debugging. Here again, get long. We don't take it because we're below the low value area. Here's a short that gets nicked. Now this is just the life. That's nicked. That's stopped to the tick, and so this is what's hard about trading this volatility with a small account, because what you'd like to do is double your stop, cut your size in half. But if it takes you down to a single contract, then you end up it's not worth doing. You end up losing money because you're not able to take something off early and then see if you're going to get a nice run. So the single contract trader has no choices here, because you can't trade half a contract. All right, so you can see, really what you want to do is use the 20-tick stop here. So that's unfortunate. That's the kind of thing that'll want you to scratch your eyes out. This here is exactly the thing I need to see to help understand how to operate at the edge. So do you see how the price is moving down and the edge is moving down with it? And because of that, every single bar is a candidate for prediction, and that's not what we want. What we want is to, very surgically pick our spots, like we're doing here, where there's a low volume node here at this price level. And so we're going to wait till we get up there to do something, as opposed to just making a prediction on every bar. That's just insane as it happens. I know, because I tried it. In other words, the signal isn't clear enough. All right, but when we get to these strategic places, then you can see, just logically it makes sense. The market has not spent enough time, very much time at this level, and when we get to it, you can see what happens. We just bounce off of it. So one of two things is expected to happen. We bounce off of it or we blow through it. It's one of the two. The third thing that will happen is you start to build volume, and then it becomes not a low volume node anymore. All right, so that's kind of a little bit what happened right here. At this low volume node goes away because you finally have spent enough time here that enough volume is traded that it's no longer considered low volume. So I end up taking that trade kind of right at the wrong time, actually, even though it's correct in that you want to get short there. The low volume node is going away as it happens. So here you see the low value area come down to price. So before, we wouldn't get if we didn't have any low volume nodes, we wouldn't do anything till we got back up to here, up to the value area low. But you can see that's not the only choice, because if you keep trading down here, the edge of the value area is going to come down to you. And now at this point, we're inside the value area, so the rules are different now. I can take any direction now, but I need a low volume node, of which there isn't any. Okay, until we fall down to the edge. So the idea here is, again, in more normal markets where you've got like a more normal profile, you'll come down to the value area and you'll either bounce off of it or you'll blow through it. All right, because the market has to make a decision. You're at a point where not a lot of people have traded out here. All right, that's what this means. And so we're either going to bounce back up and retest the point where we have traded the most, or we're going to break through it and then go into price discovery mode, where the market starts searching for a new equilibrium. This is the worst case here, because just the way the math works out, the market is falling and there's enough volume trading that it's bringing the edge of the value area down with it at the same time. And so you're getting lots and lots of what the system thinks is, hey, I'm at the edge. The market's going to make a decision here. So this is the thing I need to figure out what to do here, how to handle this case. So I'm glad to see it happening in real time. As it happens, we try to get long here. All right, and then scratch out, and then we get long again, and the market moves enough that we move the stop to entry -5, and then we get nicked. So that's interesting because that's really what I want right there. But it's just the volatility got me. So that trade I don't mind at all. This one has me a little concerned. I look at this and go, I really don't want to be doing that when you're straddling the value area there. So I need some thought on how to approach that. Okay. Let's see what else happens here. So the blue dashed line is the point of control, meaning it's the place where the most volume has occurred. So we absolutely want to stay away from there. And this is a good example of why, is that the market will often thrash sideways like this. Okay, and the reason is that this is a price level where lots of people on both sides think it's a good place to trade. There's a lot of sellers that think that 0525 is a reasonable place to sell at, and there's a lot of buyers who think that 0525 is a reasonable place to buy at. That's what it means. This is like the point of equilibrium. And so it thrashes sideways, we stay away. And then you can see there's a low volume node sitting up here. So we kind of get closer right there, so we make a prediction. And then this is perfect. I really like what I see here. All right, the signal's not clear enough to give me a prediction to do anything, but that's the right thing to be doing. Get up to that low volume node and then start hunting for an opportunity. Same thing right there. We bump back. Whoops, we bump back up into it. All right, let me look for that opportunity. The dilemma that we have. Let me see if I can show this correctly. The dilemma that we have when the market is this wild is that it's difficult to consider it a real. What's the best way to put this? You basically have low volume nodes popping up all over the place because the market's just running back and forth. Okay, and because of that, it feels like there's a lot less of this concept of, hey, let's find a surgically precise level to trade at, because it's so wild. You've got stuff popping up all over the place, and so it's something to think about in terms of what to do and whether or not you should or shouldn't be trading. Certainly as a human, the rules were we wouldn't be trading this day, or we would be extremely cautious. We would have the rules we used to have were like, pick a direction, only go that direction, and only take certain kinds of trades, that kind of thing. With the machine, it's a little bit easier. We can set the machine to search for clearer signals. But a dilemma here is that you do end up still taking quite a few more trades than you'd like, I think. I still happen to, when I look at this, I still see, okay, this is the right place, and you can see that if I signal short here, I'm going to get a decent chunk there. Same thing here. I'm going to get a decent chunk. The problem is that the order flow in here, in these spots, it's not clear enough of a signal, okay? But it's at least the right place. That's a vast improvement over what we were doing before. Let's take a look down here. This looks like a problem. So it's a similar issue. You're at the value area for a long time, right? The price is moving and the value area is sort of straddling with it. Not quite as dramatic as before. What happens here? We get long, and we move the stop and then take a small loss, and then we get long again and we get nicked again. All right, so the two examples that we've looked at here, there actually isn't a problem with sort of how the system's behaving in terms of what to do at the edge, even though it looked to me like there was, I took too many trades there. It's just the market's too volatile for the stop we're using. So that's twice now we got nicked. I mean, look at this entry. That's a spectacular entry. You get stopped out to the tick. This looks like a bottom of some sort. So far, okay, I don't necessarily see a problem there. If I just open up the stop a little bit. So one thing to do is to do a replay with a 20 tick stop and see how that does. I love what I see here in terms of where to look for the entry. These are all signaling long though. So to the machine, the order flow looks long here. All right, and I think we didn't take a trade there because we'd already hit the max loss for the day. So what would have happened here is, you'd have taken one of these as a max loss, as a loss, and then look for the next trade. Let's see what else we get. Here's another case where this looks scary to me. I don't like this business here where you got, this long stretches of price straddling the value area edge. And I'm concerned about making too many predictions, that this is not a good spot here. It's interesting because that is a short, 297. That little long right there, you won't lose money. You won't make anything, but you won't lose any. The longs here are no good. So the fact that we're, see here, we would take these trades because we're inside the value area. So these are losses. This is so that's the problem, is that I'm worried about. This is a better example of the thing I'm concerned about. So what I should do is run this in a simulation without a max loss for the day, just so I can see all the trades that come up. The difference between the chart on the left and the one on the right is that the patterns of behavior are simpler on the left, but the model is customized to that specific location. All right, so the model that's running here is specific to the value area edge. In fact, the value area low specifically. And so you expect to get better predictions because you're you're focusing specifically on the order flow patterns that are at that location. It's difficult here, and we don't want to draw conclusions in an environment that's this volatile. Having said that, it's been this volatile for 5 or 6 months now, so it's something we got to deal with. Okay, so 5:40 today, some good data here on what to do next. Need to give this a little bit more thought on how this is behaving at the edge, and see if I want to make some adjustments there. And that is it for today. We'll see what tomorrow brings. I would expect more craziness. In fact, let's go back to here. This is the 30-minute chart. So clearly, this level down here is in play. This is 7,400, I'm sure. Yeah, that's in play for tomorrow. So we'll see if we hit that or not. If that breaks, things are likely to get ugly because again, this looked like a Fibonacci retracement to me off that down move. And so if that's the case, and you can expect this distance, we would typically go like this. We would take this and move that there, and we'd set our target based upon where that arrow ended. So we can calculate that because this is 76.90 down to 74. So almost 300 points. So 300 from there would be 7,300. All right. We'll see. The markets are crazy. I suggest caution. Be careful. Better to stand aside and keep your powder dry until conditions are a little more conducive to trading. What I did this morning, actually, excuse me, was I watched it for 20-30 minutes before I said, okay, yeah, I'm going to go ahead and do it, because it was active, but it wasn't crazy wild like you see on the really scary days. That's a pretty subjective thing, though. It takes a fair amount of experience to make that decision without emotion. So I ended up okay today. We'll see what happens tomorrow.